Investors south of the border continue to digest the latest personal income and consumption data ahead of the U.S. Federal Reserve's next rate decision, in which the central bank is widely expected to leave interest rates unchanged. I mean, obviously, there's beyond that, just the belief that the Fed has really pushed back expectations on when to start cutting. Here's what the market has been thinking, pushing back expectations for rate cuts in 2024 as that economy has remained resilient. Let's get some perspective on what's happening stateside and compare it to the Canadian picture. Dawn Desjardins, chief economist at Deloitte Canada. She joins us here in studio. It's nice to see you, Dawn. I think outside of lots of earnings reports this week, everybody was very curious about this very specific inflation gauge that the Fed likes to track. What was your takeaway?
Well, it is disappointing from their perspective, trying to tame that inflation beast. And I think, we saw the data for GDP, which on the surface was weaker than expected. But when we look at the details, it was inventories, it was trade, suggesting that, more imports into the U.S. economy and the U.S. consumer continuing to spend. So we've got higher inflation than the Fed would like to see, as well as growth that, looks weakish, but when you drill down, not so weak.
So at the end of the day, for those who are curious about what this means for interest rate policy in the United States, what's your biggest takeaway?
Well, I think markets kind of have it in hand, certainly having pulled back significantly, as your chart shows, the amount of rate reductions expected in the U.S. this year. You think back to January, I was looking at this earlier, hey, we were looking for maybe 140 basis points of cuts. Where are we today? Looking for 35 basis points of cuts. So we have seen a significant remarking of expectations for the Fed. And now we'll have their meeting next week. The last time they gave their summary of economic projections, it looked like they were looking for maybe 3 cuts. Now, we're not going to get an update to that this time. It's not till June, but it'll be interesting to hear how Jay Powell talks about that.
And for those who are trying to make sense of what this means in the stock market, I know you're not a stock market strategist, but it has felt like, just like the U.S. economy has been resilient, investors have felt pretty good about putting money into the stock market. Things got a little wobbly, certainly here in the last few weeks. But the idea of a resilient economy and inflation that is clearly sticky, but nowhere near where it was, a year or two ago, does it paint a picture that actually brings some optimism, especially if Canada can benefit from some of that resiliency in the United States?
Well, yeah. I mean, if we can benefit certainly from our export side. Now, we know we're going to get, we think we're going to get a bump because of Trans Mountain opening up. And so that's from the export perspective, all good news.
Can you just elaborate on that?
Well, just now we're going to be able to push the oil to the coast, and that's going to increase our exportability. So that's good.
That's coming soon, yeah?
Yes, that's coming very soon. And so we look at our data. Now, for Canada, we had a really good lift in January. As you recall, we had 0.6% growth in the first month of the year, which was a little startling. Now, some special factors, of course, with the Quebec strikes coming back online. But even when we look at February, it looks like the data is aligning for a gain of about 0.3 of a percentage point. So even if you get some reversal in March, still looks like we're going to have some healthy growth in Canada in the first quarter. Now, remember last year, we had that same phenomenon, and we did see the economy cool quite significantly. So, we're going to have, if the U.S. remains more buoyant than we anticipate, we will get some lift, I would think, on our export side.
I will say, just to balance that, there's a lot of people who feel a little bit meh about what's happening right now, even though the economy could be in worse shape, that it doesn't, in the real world on Main Street, feel that way right now. And obviously there's been a growing chorus of folks across the country who've been pleading with the Bank of Canada to make that pivot. What do you think the odds are that they get there soon, that they get there by, say, call it June? Because clearly that's seems off the table in the United States.
Yeah, I mean, we have June in our forecast because even though we have this bump in the first quarter, we do see, as you're saying, lots of signs that things are not, they're a little more squishy, let's put it that way, than what this number would suggest. And we started to see some slowing in our labor market. We're seeing an unemployment rate that's risen. So lots of things that suggest, Can the Bank of Canada take this opportunity? You know, we've had, I would say, some really good results on the inflation side. Are we at 2? No. Are we going to reasonably get to 2 in an economy that's running, you know, generally below its potential? Yeah, I think we are. And so we think the bank's going to be lowering the policy rate ahead of the Fed. Markets also think that. They have 55 basis points from the bank and only 35 from the Fed. So, you know, this is not a view that I think is outside the realm of possibilities.
Yeah.
I do think that they will be in a mode to reduce the policy rate. You know, we're further along, I think, on the inflation front, and we do have excess supply in our economy now.
Now, I was mentioning how the Canadian dollar, even though it's a little stronger at this hour against the American currency, that generally the trend has been weakness for the loonie against the greenback. Do you think the large majority of that is this growing consensus that the Bank of Canada will be first to cut interest rates?
I think that's, you know, we can see that being priced in to the currency. So I would say, yes, that was one of the key factors that led to this weaker Canadian dollar.
And I guess this indirectly becomes a complicating factor for the Bank of Canada because a weaker currency isn't the worst thing in the world, I suppose, for our export story.
No, it isn't. It's kind of helpful. And when we think about the import side, which is often what people are concerned about from the inflationary point of view, you know, we haven't seen significant pass-through historically from, you know, certain periods, definitely, but I don't think we anticipate, you know, a huge amount of pass-through from a weakening currency into consumer prices. And so to that end, it's not that complicated, I don't think, for the story for the Bank of Canada.
Dawn, great to see you.